Hello there.
Last week was all about the positive market news, whether that was thanks to the US election or bank rate cuts in the UK and the US. Who knows? We don't care. Our portfolios were in the green, at least mine was, and I really hope yours was too. This week's episode is all about SpaceX. How can we invest it? I'm going to suggest a couple of ways, and you can tell me which way you would agree with. This is Battle 11. I'm the Gentleman Investor. Let's invest. As always, we're going to reveal who won last week's battle. We're going to get a portfolio update, and we're going to pit two more stocks against each other. Without further delay, let's get underway. Last week I wanted to invest in Microsoft and, well, nobody stopped me, so I did, and now we're stuck with it. Let's see how Microsoft and the rest of the portfolio got on last week.
So this is how it stood at the end of last week. £225 added to each of the three portfolios, and the Battle Royale was beating the benchmark. All three portfolios in the green, but the Battle Royale winning with 3.6% ahead versus the benchmark 1.21. Let's hope they do as well this week. And here is the Battle Royale. £250 put in, and it's now worth 263. It was a fantastic week for the market, up 4.2%. Here are all of our holdings, 10 of them now, including Microsoft. And if you follow Tesla, you won't be surprised to see a massive return of 47.8%. The market really liked Trump winning with all of the support from Elon Musk. And nickel itself, surprisingly, is up 14.9%. That is our Vimto and Slushy provider. YouGov as well, jumping up 13%. On the other end, some of our losers, Money Supermarket down 12.9% since we bought. B&M down 6.5%, Tesco down 5.9%. So about more in the red actually than in the green if you look at this. However, our greens are really propping us up, Tesla in particular. It is a volatile stock, so let's see how long that can keep us going for. I think we're going to be neck and neck with the market for a while, but at the moment, with 4.2% up, I think we've got a good shot at beating the market this week. Let's find out. And here is the market. As you might remember, it's the Vanguard FTSE All World, and this week it was up 3.2%, which is massive over 7 days. However, not better than the Battle Royale. The income generator itself over 7 days, if you'll recall, that's the Vanguard FTSE All World High Dividend Yield, and that is up 1.3%. But let's see how much it's paying us out, because that's what it's all about. It is now paying us annually £7.07. That's up from last week, which was £6.94. The dividend yield has gone down slightly from 3.07 to 3.04, although the yield and cost has stayed the same at 3.08. Next payment in December is £1.49. That's up from £1.34 last week, and in March £1.35, up from £1.22. So that means for our 6-month payment, we're going to pay somebody £2.84. Don't worry, we've still got lots of time to get that up. And here it is, the overall comparison this week. The Battle Royale up 6.61%. Sorry, overall it's now up 6.61%, whereas the market up 3.62%. So we are comfortably beating the market, as I say. Don't know how long that will last, but very happy that our picks so far have proven the right ones. Thank you so much for voting.
3, 2, 1, fight.
This week's theme is how to catch a SpaceX. I love space. I think it's amazing that they caught a rocket using only chopsticks. The question is it going to be a super profitable company over the next 10, 20 years? Who knows? I don't, but I'm going to take a punt and try and invest in them. The only flaw in the plan is it's not a publicly traded company, so how on earth do we invest? Well, there are two funds that have previously invested in SpaceX, and we can invest in those. Let's take a look, and you can tell me which one is the better option and which one you think we should invest in.
First up, we have Scottish Mortgage Investment Trust. What is it? It's a portfolio that gives you access to high-conviction global portfolio made up of public and private growth companies. Why do we care about that? That's because of their portfolio, SpaceX makes up 4.6%, as you can see. What I also like about them is they've got some very interesting stocks like Mercado Libre, Amazon, Tesla, Nvidia, ASML, Meta, Ferrari, a few more chip makers, a few pharmaceuticals, all of those fun things. How have they done? Well, that is a very good question. They've beaten their benchmark of the FTSE All World over the last few years, over the last 10 years, in fact. Not staggeringly, but nothing to sniff at whatsoever. We're going to compare that to our second option, the Edinburgh Worldwide Investment Trust. Who are they? They're a trust that aims for capital growth from a global portfolio of initially immature entrepreneurial companies. So this one is going to be a little bit more risky, perhaps. But with the risk comes the potential for growth. Why do we care about this one? That is because it also owns SpaceX, and its ownership of SpaceX actually makes up 11.9% of the fund. So more risky, but holds a bigger percentage of the underlying company that we really want to invest in. The rest of their holdings are not particularly well known. Maybe Ocado there you can see sneaking in at the bottom. It's only 2.2%. I don't think it's doing particularly well, but that's the sort of stock or the sort of company you're going to get with this fund. How's it performed? Well, its benchmark is not the all world, but you will see it used to be the all countries, and they've changed it in 2014 to the S&P Global Small Cap. So a slightly different benchmark to the first fund, but as you can see, it's underperforming regardless. However, is that to be expected? Probably, with its small trusts that it's investing in, small companies that it's investing in. Is there potential for growth in the future? That is the question. So I think it's a pretty clear comparison. One is slightly more mature and better performing, but with a smaller percentage of SpaceX, and this one has a much larger weighting towards SpaceX, but more risky, more volatile, and has underperformed in the past. Again, does that make it cheap? And does it make it worth investing in? Well, you're going to let me decide. Next up, we're going to take a look at their high-level metrics according to Trading 212. And here are their high-level metrics compared. Scottish Mortgage Trust, it has a market cap of 11 billion versus Edinburgh, which has 637 million. So a very big difference in the size of these. Scottish Mortgage, again, more mature, paying a dividend, whereas Edinburgh does not. And Edinburgh is also making negative revenue and earnings per share. Although its PE ratio is minus 4.3 versus a PE ratio of 10 for Scottish Mortgage Trust. I think both of these are cheap, and it's just whether they're risky and how they're going to perform over the next few years that we need to decide. Very personal, I think, to choose between them. Pros and cons for both. Lots of speculation, lots of risk for the future. Down to personal preference. I'd love to know what yours is.
So there we have it. What do you think? Which of those two funds do you prefer? And do you think this is a good strategy at all? Let me know all your thoughts, vote for your favorite fund, and we'll do it all again the following week. Thank you so much for watching. I hope you've enjoyed this video. We'll see you next week.
Goodbye.